Welcome to this Killick Explains video and welcome to number 3 in my tax saving basics series. Number 1 is on individual savings accounts, number 2 on junior ISAs. This is number 3. What is a SIPP? Okay, so the background to this is that funding life after work is getting harder for everyone. We're all living slightly longer than we used to, which is a good thing, but we're not always living healthily for much longer than we used to. Defined benefit pensions, those are the ones that give you a proportion of your final or average salary, are kind of dying out. Companies have cut right back on those, and even the state is changing the goalposts. The state pension rules themselves keep moving. The minimum retirement age seems to keep going further away. And of course, there's a lot of economic uncertainty around. So basically, a bit of a gloomy start, we all need to be saving, arguably in most cases, for longer and a little bit harder too. So that's where a self-invested personal pension, or a SIPP, comes in. And here I want to cover the basics, a few watch out fors, and give you a source for more information at the end. So what is the self-invested personal pension? Well, it's essentially a wrapper that sits over the top of a long-term investment strategy. And that strategy can include investments in cash, securities, shares, bonds, funds, and so on. A huge range of possible ways to invest with this wrapper. And the wrapper does a very simple job. It essentially protects you from tax. Now, things to know, employers and employees can contribute to a self-invested personal pension once set up. It's very flexible in terms of the way contributions happen, so they can be stopped, they can be started, they can be varied, and so on. You can transfer from one provider to another. It shelters everything inside it from income tax, capital gains tax, and also potentially inheritance tax, and that's worth knowing. And better still, you get tax relief on contributions. So as money comes in to the shelter, if you like, 80 pence becomes £1 for a basic rate taxpayer, thanks to HMRC adding a little bit extra on top. 60p becomes £1 invested for a higher rate taxpayer. You get the first chunk from HMRC at source, as it's known automatically, and then you fill in a couple of boxes on a tax return to claim the rest. That comes through later as effectively a cash rebate to your bank account, and ideally you then remember to recycle that back into your pension. Okay? Now all of that is fantastic. So you're getting effectively extra money invested by the government on your behalf inside this tax shelter. But there is a price for that, and the price is that the current minimum age at which you can access those funds is 55. Now at 55, again, lots of choice. In the bad old days, you didn't have much choice. Now you do. So some of those choices include taking a 25% tax-free lump sum. With the rest of the fund, you could buy an annuity. That's a sort of guaranteed income stream from a life assurance company. Or what quite a few people like to do is keep control and draw down on a regular basis instead. All right? Now, which option you take is very much down to you, but the point being that at 55 there's a lot of flexibility, including, of course, not taking anything out of the pot and allowing it to grow further. Now, what about some twists, some things to watch out for, some things that make this product a little bit more complicated than, say, an individual savings account? One of them is the lifetime allowance. Currently frozen at just over £1 million. It represents, if you like, the maximum value of benefits which you can draw on. So a little bit of a game, if I can call it that, required of long-term investors here in terms of trying to predict where the value of the SIPP might end up, and ideally, in many cases, trying to keep it just below the million mark or slightly over £1 million. What happens if you breach that threshold? The answer is extra tax becomes payable. And the lifetime allowance is tested more than once. It's tested when you get what's called a crystallization event, which will be deciding to withdraw money from your fund, say age 55 or 60, and it's retested age 75. And if you think I'm throwing a lot of detail at you here, I'll give you a reference source for more information at the end. There are also contribution limits in terms of what can go in to this tax wrapper every tax year. Currently that limit is £40,000, but subject to some income, sort of almost affordability tests if you like, and you could carry forward 3 years of unused allowances, but watch out, because if you're thinking, well, that sounds great, over a certain level of income, and again I won't go into all the tests here, there is a thing called tapering, which basically reduces the maximum amount you can pay in to a pension pot, and if you were to crystallise the pot at any point, that also reduces the amount you can pay in. So quite a complex area to manage in terms of how much can you pay in and what's the likely projected impact on that lifetime allowance ceiling I mentioned. A few final points to mention. Big benefit of a self-invested personal pension over an ISA under the current rules is that a SIPP is not part of your death estate. It can, in theory, be fully inherited by children, even grandchildren, and so on, subject to the fact that in their hands there may be income tax to pay when they start withdrawing. But that's still a big benefit from an inheritance tax point of view. Now, a lot of extra information thrown at you there, a lot of extra twists. If you'd like to know more, please do access my comprehensive video library, killick.com/learn. And another way to get more information is a couple of the guides. Here's some examples next to me. One is about funding life after work, the way in if you like. The other is about generating an income once we stop work or dial it down, once we achieve peak savings, as it were. For a copy of either guide, editor@killick.com.